A major development occurred in November 2007 when, to the surprise of most, the SEC dropped the requirement that foreign registrants affirm use of IFRS as issued by the IASB and reconcile their earnings and shareholders' equity to U.S. GAAP. Ever since the early 1980s, as I mentioned before, the SEC has said that if companies coming in from overseas into the United States to trade their securities do not use U.S. GAAP, they must reconcile whatever they're using to U.S. GAAP. And finally, they said that if a foreign company comes to the United States and affirms use of IFRS as issued by the IASB, it no longer needs to reconcile their earnings and shareholders' equity to U.S. GAAP. This was a big boost in the stature of the IASB, this recognition that many had thought might never occur, but finally came through in November 2007 by a unanimous Securities and Exchange Commission. And then interest began developing within the SEC, led by Chair Chris Cox, in possibly moving toward required adoption of IFRS by domestic companies in the U.S., something nobody ever thought might occur. He was an advocate of this. And in August of 2008, the SEC approved a rule proposal with a roadmap for eventual adoption of IFRS by U.S. registrants in 2014. However, at the end of 2014, Cox left the commission, as did the chief accountant and other advocates of this particular position, because there was a change in administration. There was a new president, and typically chairs resign to enable the new president to appoint a new chair. And as comments began to be received on the rule proposal, it was clear that there was a strong negative reaction in the comment letters to this proposal, and a coolness eventually toward the proposal by subsequent SEC chairs, and finally doomed the rule proposal. It never went into effect. Interesting development in May 2008, the American Institute of Certified Public Accountants revised its Rule 203 to recognize IFRS as an acceptable alternative to FASB standards when giving an audit opinion. This meant, as a practical matter, that for companies in the United States securing audit opinions from their audit firms, that they don't have to use the standards issued by the FASB. Alternatively, they could use international financial reporting standards and still receive a clean opinion on their financial statements. And this meant, rather ironically, that while companies registered with the Securities and Exchange Commission that were domestic U.S. companies were not allowed to use international financial reporting standards, the millions of private companies in the U.S. that were not registered with the SEC could potentially do so because they could adopt international financial reporting standards, and the auditor could give a clean opinion on that basis. And so therefore, if there were companies in the United States, private companies, that were subsidiaries of overseas corporations that were using IFRS, the subsidiaries in the United States also could use international financial reporting standards and get a clean opinion in their report to the parent company overseas. So this was an important development within the United States. And then back at the International Accounting Standards Board, numerous major jurisdictions signed on to the required use of IFRS. South Africa, Hong Kong, Canada, South Korea, Brazil, Mexico, indeed, most of Latin America, while China has pursued a policy of convergence. And convergence has gone so far that there is very little difference now between Chinese accounting standards and international financial reporting standards, even though China does not formally adopt international financial reporting standards. Japan has an interesting policy. For a while, it was, like the United States, considering the required adoption of IFRS by Japanese companies. But then when the US backed down, Japan backed down, and instead adopted the position that Japanese companies may voluntarily adopt international financial reporting standards. And quite a few have. As a matter of fact, the Liberal Democratic Party that has run the Japanese government for many years said in 2016 that they encourage companies to adopt international financial reporting standards, a rare instance of how a political party has made such a statement. And today, approximately 220, 230 companies in Japan listed on the Tokyo Stock Exchange with a market capitalization of about 42% of the total market capitalization of the exchange have either adopted international financial reporting standards or have announced that they plan to do so. So that's quite a voluntary development in Japan, where quite a number of major Japanese companies listed on the Tokyo Stock Exchange have adopted or plan to adopt international financial reporting standards. We return to the World Bank. Shortly after the Asian financial crisis in the late 1990s, the World Bank initiated a major program called Reports on the Observance of Standards and Codes, Accounting and Auditing, by which a team of the World Bank based in Vienna would visit developing countries and countries with emerging economies around the world and do a major study of their accounting, their auditing, and their corporate governance, and then write a report submitted to the company and his country, and so long as the country did not object, it was published. Some 70 or 80 such reports were eventually published, and the project went on for quite some years. In its report, it was invariably the case that at the end of the discussion about what accounting standards companies in that country were using, that if the country had not yet adopted international financial reporting standards, the World Bank urged the country to do so. Or if it had begun to do so, it urged the country to continue the process and very soon complete it. And so the World Bank became very proactive. And today, when the IASB likes to say that 120, 130, 140 companies or countries around the world have required adoption of international financial reporting standards in their published financial reporting, companies' published financial reporting, most of them are developing countries or countries with emerging economies. And most of them are there because of the World Bank. So behind the scenes, the World Bank has played a very powerful role in encouraging many countries around the world to have their companies, their listed companies, use international financial reporting standards. And then in 2009, the IASB issued a very long standard, 230 pages, on IFRS for small and medium-sized entities, and was recently revised, as a matter of fact, at least in exposure draft form. And it prompted the FASB's Oversight Foundation to create the Private Company Council in 2012. For decades, the FASB paid no attention to any special accounting for small and medium-sized entities. Well, there were a few paragraphs in reports that gave guidance, but nothing very significant. And then as soon as the IASB adopted this major standard on IFRS for SMEs, as it was called, which began to be adopted by many developing countries around the world, the FASB's Oversight Foundation decided finally to create a private company council, which makes recommendations to the FASB, and several have been approved since 2012. And then we return to the convergence projects, the major convergence projects, of which there were a number. In 2014, the IASB and the FASB converged standards on revenue recognition. This was a major achievement on a highly complicated subject on revenue recognition. In 2016, the IASB and the FASB converged their leasing standards on the balance sheet for capitalized leases of lessees, but they differed over a common income statement. So it was not a complete convergence. Nonetheless, they converged on requiring for almost all long-term non-cancelable leases the assets and liabilities to appear in the balance sheet at their respective present values. With respect to the income statement, however, there was a problem. And again, it involved an industry. It was the property industry. And the property industry, with leases covering buildings, go over very long periods of time, 30 or 40 years. In the past, for constant payment leases, they simply recognized rent expense every year because in the past, their property leases were not capitalized. And now they were willing to say, okay, we accept capitalization on the balance sheet, but we don't want to have a declining total expense starting at a very high level because the initial amount of interest expense is based on the initial balance in the lease liability. And it gradually declines as the principal portion of the lease liability is gradually paid off, such that in the later years, the total interest expense is much lower. The depreciation expense would be level at straight line, but the sum of the two would be a very high total lease expense in the early years, counterbalanced by a very low total lease expense in the later years. And the banks, the property company said this was unacceptable. We want to go back to have a level amount of expense, the same amount each year, for constant payment leases over 30 to 40-year periods. The property industry made this proposal to both the FASB and the IASB. The IASB rejected it and said we would not accept it. The FASB felt it had to go along. And so it created a special category of capitalized leases called operating leases, which in effect said that the declining interest expense every year would be offset by a rising depreciation expense, a little bit like compound interest or annuity depreciation. And therefore, the sum of the two would be a level level total lease expense every year during the lease agreement for constant payment leases, and satisfied the property industry. And in this respect, there was a lack of convergence in the income statement, but convergence in the balance sheet. 2017, the IASB and the FASB finally had to acknowledge that they could not converge on a standard on insurance contracts. Many of the insurance products in the United States are very different than the products overseas. The nature of regulation of the industry is different in the U.S. than it is overseas. And there were enough differences in the circumstances that made convergence on an accounting standard infeasible. So on that subject, they had to agree that there would not be convergence. And then in 2016, the FASB, in effect, departed from an earlier convergence, because in 2009, the FASB and the IASB issued converged standards on financial instruments, IFRS 9, under which both for investments in equity and debt securities. The options would be trading, which is fair value taken to income, available for sale, fair value taken to other comprehensive income, and for debt securities held to maturity at historical cost. Well, the FASB went along with that in 2009, but 7 years later, in 2016, it decided that for investments in equity securities, available for sale is no longer available. And it began to require that unrealized gains and losses on investments in equity securities be taken to income, contrary to the IFRS position, which says that at acquisition of an investment in equity securities, companies have an irrevocable election to decide if they want to take the losses and gains into other comprehensive income as opposed to net income. So beginning in 2016, there was a divergence between the FASB and the FASB in accounting for investments in equity securities. 2018, the IASB issued its completed conceptual framework, the first completed conceptual framework since 1989, done by the old IASC. One of the significant elements in it was that for definitions of assets and liabilities, the IASB dropped its probability criterion and therefore potentially opens the door to a broader expansion of assets and liabilities than under the previous conceptual framework. Time will tell the extent to which this new conceptual framework leads the IASB to revise some of the earlier standards with respect to its new definitions, its more relaxed definitions, I would say, of assets and liabilities. Now, with respect to the future, there are a couple points that could be made. With the major convergence projects behind it, the IASB turns its attention to what is called maintenance, post-implementation projects, assessing the previously issued standards in the light of subsequent events and their possible revision in the future. And while formal convergence is over, informal convergence still exists because every year the IASB and the FASB have an informal meeting, and there is very frequent contact between the staff and the members of the FASB and the IASB throughout the year. So there are still activities leading toward potential convergence in the future as a result of this informal activity on the part of both boards. Nonetheless, most of the work ahead is going to be under the heading of maintenance, which is not as attention-getting as the major projects which it dealt with in its first couple decades. And so therefore, with its major standards behind it, will the IASB succeed in continuing to attract talented professionals to become members and staff? And this will be the challenge, because as the issues become less momentous and less significant, but important nonetheless, how many professionals will agree to join the board and become staff members? So far, the board has been successful in attracting a lot of talented staff and talented members. It will be interesting to see how far into the future this can be continued. Thank you very much.